The pressure against e-cigarette company Juul Labs has been mounting, and it's now spilling over to cause some big changes in leadership and planning at the company and beyond. The vaping giant that controls about 3/4 of the e-cig market announced its CEO Kevin Burns would be stepping down from his role, and that the company would cease all broadcast and digital advertising. Stepping in to replace Burns will be Altria's Chief Strategy and Growth Officer, Casey Crosthwaite. And remember that Altria, the maker of Marlboro cigarettes, paid about $13 billion to take a 35% stake in Juul late last year. In more fallout, Altria also announced that it was ending merger talks with fellow big tobacco company Philip Morris. Its CEO said that, quote, "While we believe the creation of a new merged company had the potential to create incremental revenue and cost synergies, we could not reach agreement." Guys, importantly here, Philip Morris is up on that news, but also staying in place is the partnership with Altria and Philip Morris to market their own heat-not-burn vaping device, IQOS, in the U.S. So while they're not going to merge anymore or exploring that opportunity, they're still going to be working together to sell that one device.
Yeah, I mean, when you look at what's happening in terms of Juul, so it was a fantastic success story. They grew so fast, and they were getting all these e-cig sales when you see these traditional cigarette companies struggling to make those sales. So that's why we saw Altria actually buy a 35% stake in Juul of $12.8 billion worth because they want to get into that market. And then you also see like the talks of the merger between Altria and Philip Morris. But now there's cold water on all that because their flavored e-cigs account for more than 80% of their sales, and those are specifically the types of sales that the U.S. government is going to be preventing very soon. That's what the White House says that they're going to be targeting and stopping. So Juul is basically, cutting their losses right now. They made a lot of money. When you don't feel too bad about the employees, they're doing hiring freezes now, but when Altria bought that $12.8 billion stake, they spent more than $2 billion in cash for some of the employees that were already there. This is in December of last year, and they each got $1.3 million each.
Yeah, that was the average. That was what it averaged out to across employees.
So
of course, it wasn't evenly split
when you're feeling bad for
I remember reading notes when Altria made that deal, and you had people who were critical of that deal saying, "Whoa, Juul, we don't even know. Regulation has not even started on this, and when it does, it's going to be vicious."
Yeah,
I mean, that's why Altria's down and Philip Morris is up, because Philip Morris, I think
they don't have that overhang.
He read those notes and they were like, "Let's not."
Right. Yeah, that's a good point.
Something that we're going to get wiped out on as soon as Chuck Schumer gets his way.
It's a very good point, and it's hindsight 2020, of course. But I mean, when you look back at it, it does look like that's shaping up to be one of the worst large corporate investments you got to think about here, because especially if there's now a criminal probe into Juul as well, which was opened earlier this week. So you got to think about what might happen at that company and what Altria's stake might be actually worth now if they paid $13 billion for it back then. Hey investors, Zack Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.